What's going on YouTube? All right, we're back again. We're going to keep giving you these videos continuously on a regular basis, guys. I said to you, I want to help you. So this is what my goal is, and this is how we're doing it. So today's video, lesson 4, why you're reading price wrong. Now, I'll probably get a lot of people challenging this. Frankly, I don't give a shit. Why? Because I'm following a business model that has been applied by the market makers. It's their business model. I'm just merely riding the way it moves. Okay? So I'm going to get to it and just make the decision yourself, guys. All right, guys, what's up? Okay. Right in front of you now, you can see the chart for dollar yen. It's on the 1 minute time frame. Now, this was during the election results as the ballots were coming through, all the counted votes were coming through, and they were showing favor to Biden, or they were, and then you had Trump challenging and all of that madness that was going on. Now, this was a very difficult time trading, you see, because when we're involved in such a uncertain time in terms of the election, no one knew which way it was going to go on the 4th, that is. And certain levels, well, price behaves in a certain way, and if it's influenced by news, then you're pretty much gambling here. Now, for me, the reason why I took trades on this day was because the way price was behaving, it had already absorbed the likelihood of what it would be like under Biden's power, or if we continued with Trump's power. All right. And that's the thing about the market. The market will always absorb the information beforehand. And then all the traders that step in thinking, oh, right, Biden's taken over. Let's get in, put our positions into whatever pair's looking like it's favorable. All right. The market makers have already set price up for you guys to come in and fill the liquidity so that they can get their orders closed based off your liquidity. This is what you've got to understand about trading. The market makers use retail traders. Now, in retail traders, I'm referring to us. We can also be referring to bank traders, hedge funds, you name it. As I said to you in a few videos before, there's 2 types of money, smart money and dumb money. Which side are you on? I want to follow the smart money. So, looking at this chart, guys, all right, there are certain things that have come into play, and I'm going to dive into what I'm looking for. All right. Now, just remember, guys, yes, you're probably thinking, when are you going to give these indicators so that we can start using them ourselves? What I don't want to do is give them to you, and then you guys come in asking me 101 questions on what is this, what is this, what is this? And then it's going to be too much, and there's not going to be no structure. The more you review these videos, when you do receive the indicators, you guys are then, unless you've got them already, right? But once you do get them, you'll then have enough information behind you, and you can then refer to these videos and then say, right, this is this, you'll be able to start marrying things up easily. All right. So remember, this is a course, guys. I don't want to just give you everything in the first instance, because you're only going to come back to me and ask me 101 questions. And then I'm going to be like, right, I can't really take that. There's too many questions here and there's no structure. And then you guys are going to think, oh, what is this? It's like a waste of time. All right. So just bear with me and just take in what I'm going to be explaining. You'll thank me later for it. So I pulled up the 1 minute time frame. Now, the 1 minute time frame for me is my entry, but it's also where I am looking at understanding what price is doing. Guys that trade the daily, the 4 hour, the 1 hour, there's nothing wrong in trading that. All right. Some people need more confirmation. All right. But the problem is, the nature of my trading style, being a scalper, I'm going to miss the move. I'm going to miss 101 moves, right? If I base my entries on the daily, the hourly, or the 4 hourly. Some guys are making money from the higher time frames, and brokers and all trading teachers tell you to use higher time frames because you're able to, when you see a certain candlestick pattern form, there's more conviction on the higher time frame. All right. But for me, I don't really like to do that. The reason being is because I'm following a business model, and that business model is the market maker's business model. And the market makers trade by the minute. All right. They scalp. Market makers scalp. They're in and they're out. So why am I going to copy or follow anything else? Why am I going to expose my capital to massive swings? Like when I see guys putting up charts and they say that they brought here and then they sold here, and I look at their stop, when they're putting like, 30, 40, 50, 60 pips stop loss. Wow. And they say to you to cut your losses. Like, guys, unless, for example, swing traders, if you haven't got anything more than, I'd say, 100 to 250,000 pounds as your capital, don't even bother swing trading. There's no point, because in order for you to make a decent return, you need to be able to sit through the drawdowns. You need to be able to sit through the massive swings. All right. For me as a scalper, I haven't got time to do that. My character as a person, I'm impulsive. I'm in and I'm out. There's no time to mess about. I don't like the idea of having my money on the line and it's exposed for such a long period of time. I remember I used to be able to swing trade, and I'd be putting down money and saying, right, I'm going to risk 50 pips to make 100 pips. Now, in comparison to my trading account balance, 50 pips, if I lost 10 trades in a row, right, that's me out the game. And that happened to me. And that happens to a lot of traders. Some traders think that the wider the stop, the easier it is for you to get a profit. Wow. But I'll explain more. Here we go. So, looking at this chart right now, there are several things we've got to pay attention to. All right. So you can see these two big spikes. They both hit the MR3. The MR3 is the monthly resistance. Okay. The MR3 is the third part of the monthly resistance where price has been before. Okay. I'll explain more about the figures itself. It's the third level of the monthly resistance. That's the best way to put it. Likewise, the daily range 2, that's another area as well. Okay. So when I pulled up the chart, considering the fact that we were in the election period, all right, I was looking and I was thinking, right, we are effectively in a little bit of a range. Now, from the 105,100 to the 105,100, 104,900, these are 10 pip moves. All right. So you can see that we are in about a 20 pip range looking at this. All right. So when I pulled up the chart, I looked and I thought, right, okay, I can see these big green candles here and these big sell-offs. Green candle, sell-offs. Now, in the last video or in the live trade, I mentioned to you guys that when you look at these green candles and these red candles, okay, what are they telling you? They're telling me, based on how I understand the system, that when price goes to the upside, market makers are building their shorts at the highest possible price in order to close them at a lower price at a later point. All right. So you can see here, price spiked up and then price dropped again. So here, I saw this and I thought to myself, right, market makers are setting something up for them to get their shorts at a higher price and then instantly close them. Tells me that something's brewing. They want to give the impression that the market is going to stay in this range and it wants retail traders to step in. All right. Because you can see, look, climatic behavior. Oh, it's exciting. Let's catch the trend down. Is it going to be short? And usually when this sort of behavior happens, the market makers do a great job of making retail traders believe that there's going to be a sell-off. All right. Which is evident from this candle here. Price pulls back up and then it continues. So lots of retail traders came in as price was rejecting these highs. All right. Then this is where it starts to get interesting. Bottomed here at the monthly resistance 2. It's stuck in this range of the 104,900. Now I'm paying attention to what the candlesticks are doing. And it's these red ones and the blue ones here. The red one here is, again, the market makers getting their Longs, right? They're getting their buy orders opened at lower prices in order to close them higher at a later point. And then coupled with the fact that we are at a monthly resistance, the market makers know that there's going to be thousands of traders watching this key area here. So they're going to allow the retail traders to step in and go for a buy. So they allow the liquidity to fill their orders so that they can start closing them on the way up. All right. Now, this blue candle here was the London Open. All right. So it's one of the best times for the market makers to step in and start making price move in the areas that they need it to go to. All right. Always remember, the opens are the best time to trade. Now, I always aim to try and trade the opens, but I don't always trade them because there's not always an opportunity to trade the opens. But it's the best starting point. You know, after the first 2 hours of the open, that window there is great to trade. All right. Now, from the London Open here, price rallied all the way up here. Now, when I saw this, all right, I thought to myself, okay, the market makers have intentions of going short. Now, the only reason why I knew that is because the market makers build their positions, or should I say, they build their shorts above key notable areas. All right. So the key notable area is here, the 10500 mark. Now, in the last video, I talked to you about the phenomena about whole numbers and half numbers. All right. When you go to a shop and you see they say you can buy this for $24.99 and they never give you a round price. But if they want to discount it, they give you a whole number because it's more effective. All right. Same principle here. The market makers sent price up. So they started building their shorts above this area here. All right. They did the same over here, but they closed them and built more longs whilst they were starting this sell off here. All right. Now, after these two green candles appeared, it showed the retail traders that there was support here. Well, should I say resistance? It's tested the resistance and failed. All right. So a few retail traders would have shorted from here. Now, the market makers used those retail traders' liquidity to get their longs filled at lower prices. All right. Because retail traders believed that price was going down because it touched the monthly resistance twice and it failed. So they sent price down and market makers then pushed price down lower back to the 104,900 mark. Now, when you're looking at this area here, let's consider the retail traders. They're looking and they're saying, right, the 104,900 area looks like it's got good support, but I'm not seeing that support. Reason being is because I'm not seeing climatic behavior. I'm not seeing the market makers step in. I mean, look at the volume at the bottom here. There's nothing. But if you look at the volume here, you're seeing the market makers are getting busy above the key price, which is here. All right. Remember, market makers build their shorts above key areas in anticipation to close them at a lower price. So they will build up and then they will smash all the way through back down. Same again when they're doing it below a key area. They'll build their prices, their orders below this area, and then they will smash through to the upside. So they build their longs below key areas in order to close them at a higher price later on. All right, so I'm going to press play. Now, as I explained to you earlier, my conviction was that the market makers were effectively preparing to sell off. And that was based on these two spikes here. All right. So at the same time, I thought, right, would we see the 105 mark again? Now, this is where I made a mistake as a trader. I did get greedy, you know. Watch what happens. Now, I'm in my entry. I've got my two positions there. And I'm thinking, is price going to hit the 105 mark? It is quite close. It's a key area. Surely the market makers are going to try and aim for that. So I started playing the waiting game, you know, paying attention to what's going on with price. And you can see that it's starting to look like it's showing support. And now I'm in profit. You see how aggressively it moves up there. So at this point, I'm thinking, right, okay, my conviction was correct. You know, I was right that they could actually see to hit the 105 mark. What I'm going to do is once price gets to that area, I'll be looking at closing it unless it tries to go and retest the monthly resistance again. And it did just this. It did hit the 105 mark. There's me, you know, telling you the answer beforehand. I shouldn't be doing this, man. I need to let it play out. We've got to have some suspense. Just look at how price is behaving. And plus, guys, you need to get used to doing this. You need to get used to watching price. Paying attention to the pumps up and down. See how it stalls. So at this point, I'm thinking, is it going to hit the 105 mark? Surely it's going to hit it. So I'm effectively managing my trade here. I'm thinking, okay, look, if it hits it, then if it can break past the 105 mark, it should look to try and hit the MR3. So I'm holding the trade, seeing a little bit of profit, like 2% profit, happy days. Now as a scalper, I should have really took that. And there we go. We hit the 105 and then it started going up. And I was like, okay, great. You know, I've made the right call here. So 7%, happy days. Remember, this is a small trading account, which we're going to start talking about in the next videos. And at this point, I'm thinking, okay, yeah, it should look to hit the MR3. And price started to stall here. Now you notice I'm not really seeing, you know, massive movements, all right? It's giving the impression that it wants to try and hit the MR3 and try and tap into this double top here. So I just thought I'd leave the trade. I'd leave it and just, you know, let it play out. Let me jump forward. See, jumped up again. Now it's at this point where things started to get a little bit more interesting. I made the conviction that this area here, the 104,900 mark, was support. Now I should have really taken what was available on the market. There was 7% there. I should have took that trade. I should have closed it and then looked to stay with my previous conviction that I believed that the market was getting ready to go short. Now, retail traders would have seen this as an opportunity to enter, to go long, which is what the market makers were doing. They were allowing the retail traders to believe that the market was now set to go long. So you can see here, we've got volumes not coming in. So I mean, it's for me, looking back at this now, I'm thinking to myself, the signs were there for me to close this trade and get out. Let me jump forward. It's starting to pull back. Jump forward again. Starting to pull back quite aggressively. And then you can see what happens. Now at this point, I'm thinking, yeah, it should try and retest that area again. And jump forward. And then before you know it, there was that one last test where I thought to myself, yeah, it could try and retest and try and break out to try and hit the daily resistance up here. You know, I was very optimistic about it because I believed that this area here was showing the great support. But in the back of my mind, I knew that my conviction previously was that the market makers started showing me behavior that they wanted to go short. So I was in a battle there, you know. It's a very small account. Once this candle arose, okay, I thought to myself, right, I need to close it because it's not going to go back up. But, you know, I was being hopeful here. I started looking at gold. So I'm thinking to myself, right, shall I close this trade or not? I opened up the bottom tab here because I needed to get ready to start making a move. And then this is the 1 minute time frame. You can see that there was no activity. They didn't, the climatic volume here and no follow through. Now I'm in the losing position. Just paying attention to what price is doing. Now, I feel like my decision on this trade here was like, right, look, you could have taken out your gains up here, but you chose not to because you thought that price was going to go and continue. But, you don't know that. And this is where I am right now. The position now is bang on at my entry. And now I'm feeling like, right, I need to do something. Is it going to continue? Is it going to show support here at the 50-day moving average? And then it starts to go south. So I'm looking at it, I'm thinking, right, what do? I need to get out of this. And I thought, right, if I get out of this, will I go back to my previous conviction? Which was to go short. So I'll skip it forward a bit. Started to stall and stay in this area. And then one more test to the upside. So they're me thinking, right, okay, I've managed to salvage the trade a little bit. I should really close this trade. Didn't do that. I kept in the trade, stayed in the trade, and then it started to get busy. You can see that there. And now, several candles later, you can see that it went all the way down here. So I closed that trade, all right? Now, if my previous conviction of me thinking that the market makers were short, had I stuck with it, I probably would have entered once this candle closed. So I would have, I said earlier, I would have entered at the break of the 104,900 mark, right? But this is what trading's about. You're not going to get them right all the time. But what you need to do is you need to set yourself parameters and you need to close them when you know you're wrong, okay? And be prepared to move to go into the opposite direction. Because, there's a saying, good traders cut their losses, but great traders change direction. Just because I lost on this trade here doesn't mean that my conviction based on what I'm seeing over here is not going to flourish. But that's what I thought at that point in time. I thought, right, I could have made some money up here, but I chose not to because I was being greedy. The signs were there for me. Follow through volume here didn't come in, okay? Climatic volume, this grey candle here was a retail trader's candle. This green candle here is a market maker's candle. Now, if we look at it on hindsight, we're going to say that, well, I should have closed either at the top of here or even just slightly here or at the first break of the 10500 mark. But I didn't. Why? Because I'm human. Sometimes you get a bit confident and you feel like, you're going to, you think you can master the market. You can't. This is a sort of example that, that you need to see. Now, by you guys seeing this, what value you can take from it is if you're going to set yourself a point where you think that your price is going to go and you think if it does hit it, you're going to take the money, take the fucking money. All right. So let's keep going. Now, I've closed the trades. And it was at this point where I thought, right, it's starting to get busy. All right. So I thought 104,900 mark, is it going to get broken? Let's see. And I started moving things around, started looking at the charts. And at this point, I'm listening to Twitter as well. So you can see I'm starting to behave like, right, okay, what's going on? Right, am I going to make an entry? What should I do? So then I entered short. I opened the shorts again. Based it on my conviction previously. Keep going. I opened another trade. Notable volumes come in. This big red candle here was the sign that the market makers are stepping in to start moving price. So I'm going to fast forward it a bit. So things look like they're moving in my favor. I'm looking at the higher time frame, the 5-minute chart, notable volume here, big red candle, market makers are stepping. You look at how price is moving, being very aggressive. Looking at gold, gold's going up, dollar's going down. So based on this candle here, this candle would be a mirror of that, telling me that the market makers are now starting to offload and get into the markdown phase. So look how aggressive that is. Look at how aggressive that is. So I can see the 200-day moving averages in sight, on the lower time frame, the 5-minute time frame. You can see that it's here as well. It's very close to the 5-minute time frame. So I was thinking to myself, okay, would price hit that area? How strong is this move? But based on what I'm looking up here with the market makers big jump ups, okay, I'm basing that, we're going to see this area down here. So the 104,800 mark was looking like an area that it was going to hit. So we pay to play. That's what we do. Let me fast forward. We're right on the 15-minute time frame. We're right on the 50-day moving average. So one or two things could happen. Price could come in and start showing support. So we waited. Skip. Looks like it's stalling. Remember, it's just offloaded quite a bit. And there are now traders that are going to be rushing to cover because they previously went long. The market makers now taking out all those stops. That was a stop hunt there. And look what happened there. Look what happened there, guys. Let's rewind it back a few seconds. Right? Price tanked down. And then this candle here appeared. From that point on, I realized, okay, that the market makers would probably attempt to send price back up. Okay. Now, when I saw this, I thought, right, we could be in line for the markdown phase. But things changed at an instance. Look what happened. These were my entries. So I entered here and here. I could have closed down here, but I closed up here. So this is another example of when you're not sticking to your conviction, all right, and you're not waiting, you become very hesitant. This is me hesitating now. But in the back of my mind, I know for a fact, okay, that the market maker's bias was to go short. Look, the signs were there. The green candlesticks were shorts that were coming in above a key area. Okay, so they're sending price higher so that they can close it, get their shorts filled at a higher price to close them at a lower price later on. I'm trying to find that moment where they do that. And yeah, I'll lose a bit of money, but I'm only losing a small amount of money each time it happens. And I enter and I exit until I find that sweet spot. This big candle here took me out. I manually closed that trade. It took me out because I knew for a fact that it could try and reattempt to hit this area here. I didn't want to keep that exposure there. So I carried on. And then we're waiting. I'm still now looking for an entry to go short. And I just need to see the confirmation. So you can see it's getting aggressive now. So I thought I'd wait a little bit. And then I took my trades. That big white candlestick there, grey one, was a fake out. That's my conviction for me re-entering. Keep it going. I opened 2 positions. So I'm thinking, okay, is it going to continue now? Because it hasn't closed above the 104,900. It's broken it and failed to break past it with this big candle here. Failed. So I thought, okay, could we be in for the actual move? I looked at the 4 hour, just zoomed to the 4 hour, and I can see that here. This is critical here. This is the 4 hour time frame. Okay. These were the signs here that the market makers were getting ready to set up for a short. Okay, but this is a 4 hour time frame, so you have to base your decisions on a 4 hour length. Okay, but this candlestick here is where we are right now. It's rejected the 200-day moving average. The 50 days effectively flat. Okay, but usually whenever this happens, whenever this big green candle appears and fails to actually close to the higher side, the candle preceding it will be the confirmation candle as to whether it's going to continue further up or it's going to go back down and fill all these shorts that were taken at higher prices. Okay, quite confusing, I can appreciate that, but I'll be explaining that sooner. So we're looking now right on the 5-minute time frame. So right now I'm thinking, okay, I've lost quite a bit of money on the account, but I cut my losses short. We're in this election point and things are just all over the place. I just couldn't, pinpoint what my entry was. There was not really any structure here, but I knew that my bias in the first instance was that the market makers were short, and that big red candle there was the first trigger. So you could say that I was being very hesitant. It's like I was trying to force the market onto me. And that's one thing you can't do, guys. You can't do that. You can't force a position. This is an example of forcing a position. Learn from this. Okay. So I added another position. See how prices just isn't doing anything. It's very influenced by news. I looked on my account and I was down quite a bit. See, pulled back up to the 104,900. I'm thinking, okay, is it going to show support? Is it going to continue to the upside? What's going to happen? At this point, I was like, right, the market makers are really playing a tough game here. And this was a really hard day for me in trading. It really did push me and test me, because I just thought, you know what? I shouldn't trade this in the first instance. I didn't want to trade on the day of the election, because in my past experience, I knew that if there was any news coming out, I stay away from news completely. It has to be a clean day for me where nothing's going to influence the market. So, and there we go. We now have the start of a new candle on the 5-minute time frame, and it was bang on 11. So it was a new hourly candle, right? And momentum usually comes in every hour, all right, at the start of an hour candle. So this is where I thought, okay, if the 104,900 mark doesn't get broken, then we could be looking to hit at least the 104,800 if it plays out. So I zoom back out just to get some clarity on the position. See, I'm reasserting to myself, really, are the market makers actually looking at going short? So I'm going over it again and again and again in my head. This is not usually how I trade. Usually I'm in a trade and I'm out, and the market is actually performing optimally. It hasn't got no influence of any, election or any news, So I was really paying attention to this. And I was like, right, am I going to have to get out of this trade? Because it just looks like it's stalling. But then this happened. I saw that aggressive move down. I was like, right, it may look like it wants to go down further. Is my bias correct? So I'm just fast forwarding it. Fast forward. So we've been here before. We're still in the same area as before. I need to really see it break through. Okay, still going. See how it's slowly trickling down. Just making the market, the market makers are just making the retail traders believe that there's support in this area, because previously here, support came in. So they're now making retail traders believe, okay, let's start adding longs, all right, so that, we can catch the move back to the upside. Problem is, you got high, lower, a lower high, everything was setting up for this to become a short. And that's what I was telling myself. And I was just asking myself, if you're wrong, you just finish off and, stop for the day. Your bias was incorrect. But some experience was just saying to me, because I've seen this sort of behavior before, was I going to be part of a move to the downside? Now, if I look here, the amount of times that I've seen big candlesticks like this, okay, where the market makers are getting their longs closed and building their shorts at higher prices, okay, the amount of times I've seen price retrace and recover that whole area again, it's just unbelievable. All right. So this is what I was waiting for on this move. Fast forward it. I'm back on the 1-minute time frame. Now, here's where it starts getting interesting. So based on what I was saying to you, okay, that, the 104,900 mark was a previous area of support. All right. It broke that support. It's tried to penetrate back to retest it. Okay. But it's failed twice. So once here and once here. So those were the reasons why I was still holding the trade. All right. Plus, the 50-day moving average was pointing downwards. Right. So that's telling me that momentum is in the market. So the only thing that I could do was this. I could sit this out and hope that if price was to retrace, it would look to retrace back to the 104,900 mark and then continue to the downside. Or alternatively, it could just retrace back to the 104,900. Then support would come back in, all right, and then send price back to the upside. But that's not what the market maker's intention was. And then I see that break there, a retest down here. It's a range daily high. See how extended we are. We're at the highest possible range of price. The range daily high, whenever price is at the range daily high, it always looks to pull back, right? Now we are way above the range daily high, and we should be expecting it to drop. So this is what was going through my mind. And there was the break. All right, let me just jump back 10 seconds. All right. So this is where it started to get busy. It needed to break this area here for me to say, right, I'm happy to stay in this trade. And it did just that. So we'll watch how it plays out. At this point, I'm looking back and I'm thinking, okay, I've lost a couple of times. Now I'm going to be playing the recovery mode. But that sort of mindset puts you back into the frame of mind where, you know, you're just trying to make a quick buck just to break even, right? So now that I knew that this area looked like there was no support coming in, all right, because it started to make, you know, lower highs, lower high. All I was waiting for now was the market maker's momentum to just come in. You can see how close I was to my entry. At this point, I was like, right, I've lost the last couple of positions. The market is in this election mode. Do I really want to be trading this? So I made the conviction. I says, right, if it breaks past the 104,900, I will get out. But everything was just stacked to the downside. So you can see I'm just scanning through my charts. I'm looking, and then that was me just changing the screen there. And there we go. We start getting busy. 14 pips up there. I moved my bid, my alert, just to notify me, just in case I'm not paying attention at something. Okay, so the notable candle came in here. All right, so that's where I was like, right, I believe that I'm in a safe trade. So I will hold this and see what happens. Look at the volume, it's rising on the rising at the lows. So I'm going to skip forward. Skip forward. Right, I'm going to jump back. All right. Watch what happens here. So notable volume came in here. Right, so there I was convinced that, okay, so the market makers could be stepping in now. And then look what happens next. Big aggressive jump down. Earlier I said I wanted to see at least the 104,800 mark to get hit. Back down to the 1 minute. How aggressive that is. We're now testing the daily resistance one there. Down it goes. When you see this sort of candlestick happen, momentum is stepping in the market. The market makers are now moving the smart money. So this is where I started to really pay attention. 31 pips in. Usually when a big candle like that occurs, there's always going to be a retrace. Look, said it to you. It's going to look to retrace and recover this area here. Just paying attention. We're now breaking the 50-day on the 30-minute, back to the 5-minute. The 50-day now is pointing downwards. We've broken the 200-day moving average on the 5-minute time frame. So everything looks like it's stacked to the downside. So my bias in the first instance was correct. All I needed to do was make sure that I placed my entry at the 104,900 rather than trying to do a hero trade and try and take out the 105 earlier on, where I said to you, I lost up here. Here we go. More activity coming in. More action is coming in by the market makers. So I was like, okay, it's starting to slow down now. Will we see another pump to the downside? So this is the live trade. £112 in. Started moving down my indicator there. There you go. You can see the market's getting very aggressive. 42 pips. So my original conviction of the market makers going short was solidified. And it started off with this candle here, failing to break up here. And then they started the process, and that red candlestick is just zoomed out again. There we are. We're now on the 50-minute time frame onto the 200-day. Now support should start coming in here. Forward. Looking down at the 1-minute time frame. Started moving my chart because I'm ready to start closing the position. And look, the strength of this move was unbelievable. Price was so extended away from the moving averages. Momentum was in play. And it's these sort of things that we're going to be looking for. That's what I'm going to be showing you guys, okay? Because the only way that you guys are going to learn this system is if you see real live trades. And this is what's happening right now. Look at the notable volume coming in. Market makers get very aggressive. Look at how aggressive they're pushing price down. Key notable area in sight, the 104,500 mark. So that was me thinking, right, okay, I might just hold it that little bit more. But look at that candlestick there. Completely smashed and recovered the previous green area here. Remember, shorts at higher prices. They're closing them now. And also we're at a pivot point. PVT down there, there's a pivot. So I'm expecting price to bounce from this area here. Down it goes. 69 pips. Looking at gold, gold's going back up. So there is no favor in dollar yen right now. Everybody's taking their money out of dollar yen. They're aiming for the safe havens because that's what the election was doing. So I'm waiting for price to stall. That's what I'm waiting for. Usually when you see a big red candlestick like that at the start of a new candlestick, it usually continues to the downside, but sometimes it actually pulls back up. So this is where I start looking. I'm thinking, okay, I'm going to start closing my trades now, and I'm going to get out of this. So there you go. There it starts to look to retrace. So I'm waiting, and there you go. I close the trade, and we get out. So there you have it. My bias in the first instance was that the market makers were going short, and the reason being was this. These big candlesticks here, big green candlesticks. You've witnessed it yourself. I said it to you in the last couple of videos. Usually when you see these big green candlesticks, at some point you're going to see another red candlestick preceding it. And that's just happened. So it went up, pulled down. There's that big red candlestick preceding those green candlesticks there. Went up again, big candlestick there. Failed to break out, continue to the downside, and look where we are. Right, look, so you've just witnessed a series of trades taken by me on a live account, and you can see the mindset, the battle between, making the right decision or making a decision and then sticking to it, or then allowing things to change your course of thought. As I said to you guys, I'm human. And so are you guys. I'm not expecting you to embrace what I'm giving to you, right? And expect you to be somewhat robotic. And when I say, have a carefree state of mind and just place your trades, be impulsive, all the stuff that I'm telling you to do, I have to be realistic. You guys are new to it, or you guys may have been trading for a while and you're looking and trying different systems. Now that you've come across this and you're seeing how I'm using it, you can see where I do have the mistakes. I made the first two trades, a couple of trades, I was wrong. All I needed to do was stick with my original conviction. And that's what I say to you guys. If you have a conviction, stick with it. Don't deviate away from it. I didn't want to trade that day. It was election day. I knew in the back of my head that it was going to be a particular day. You know, I didn't know where price was going to go. Well, we never know, but when there's no election and there's just a normal trading day, you're able to exploit the market, because this is what I have found in my experience. But trading the election day, where at any moment things can change and levels that you expect to be respected don't get respected, and you know, you just start falling into this vortex where you're just starting to have a battle with yourself, saying, right, should I do this, should I do that? The sheer fact that I was asking myself so many questions that point in time when I was in the trades was telling me that I was in the wrong trade. But because of what I understand about this system, the signs were there for me that the market makers had intentions of sending price lower. Now, all I needed to do was wait for a certain key area to be broken for my conviction to come into play. But I didn't. I was being greedy. I was trying to take a few pips. In the end, I lost 60, 70 quid. But then, had I stuck with my initial trade idea, I would have come out on top. Now, we did see a good profit on there. All right, we lost 60 quid and we made 100 on top. All right, so £109 on top. Happy days. But I'd say it was a risky trade for me. I didn't want to trade it in the first place. And my advice to you guys is, when you do start trading, stay away from news, all right, or any elections. Just take your trades on normal trading days. Here's a little bit about how the market makers move price, all right? So the actual thing that I mainly focus on is, and only, what the market makers are doing. Before I'm looking at a candlestick, in the back of my mind, I would have already considered where the market makers are looking to send price. You know, I can't say it will go there, but I have to make a conviction that where is the likelihood that the market makers are going to be moving price based on what they are doing now or what they have done at a certain point. All right, because remember, the market makers, they leave footprints. All right, and there's only one thing that they can reveal, all right, in real time, which will tell you that they're starting to fulfill a previous a previous development of a position, and that's momentum. As you could see in the previous video, when we were paying attention to how price was being very aggressive and the 50-day moving average was pointing downwards, you know, these were all signs that momentum was coming into play. Right, so pay attention to these two arrows. Here is where the notable volume was coming in. Right, notice now that it was coming in above a key area, which is the 10500 mark. Remember, as I said to you earlier, market makers like to build their shorts above key areas in order to close them at a lower price later on. It's that later on that we won't know, and that's where we have to enter into the market and gauge where we are at that point where the market makers are looking to start their markdown phase. All right. In the last video, we spoke about the markdown phases and the markup phases, right? This is where the market makers run profit on previous positions that they built, okay? Now, notice how price pulls away from the top, comes back down, then it starts to stall. Then these two candlesticks here, the green candle and the red candle, very symbolic. It was the market makers' attempt at making traders believe that price was going to continue back to the upside, because when market makers sent price up from those two big green candles, investors were stepping in, traders, retail traders, whatever you want, were stepping in, being all excited, like, oh yeah, dollar yen's ready to make a move to the upside, I want to catch this move. Or what they did do is they waited until price pulled back in the anticipation that they were going to enter at a lower cost. All right, and those two candlesticks right here were the symbol to me that the market makers had different intentions. Notice the green candle couldn't close further in or above the 10500 mark. That there was the signal for me to say that, okay, the market makers were getting in the last bit of liquidity above the 105 mark, building up more shorts in order to close them lower at a later point. Notice the red candle after that. came right back down. Now, we've spoken in a previous video about this sort of behavior before. All right, so if you go back to the the dollar yen live trade video, you'll notice we talk about the buildup of the two candlesticks, a red candlestick, green candlestick, or vice versa, and you'll see what happens after that. We're at the same situation here. Now, after those two candlesticks, price came back down, showed support at the 50-day, and made one last attempt to the upside. That was the last attempt by the market makers, all right, to make traders believe that we could be in for a run to the upside. All right, notice it was above the key 105 mark. All right, it pulls back down, shows support. Remember, market makers are building the illusion to traders that there's support in this area and that it's going to go to the upside. There were so many people that were optimistic. And let's look at it another way. If you were to do a Fibonacci retracement on this chart, you'll probably find that at the bottom of the red candlestick right here, that may be the actual 61.8% retracement. So there were traders that were in the belief that the Fibonacci's are coming into play. And then one of the last attempts by the market makers was done here, where they made the lower high, where price rejected the 105 mark, and then the rest is history. The red candlestick that you can see is just covered up with these positions, but you can see closely the red candlestick that appears is the start of the market makers' attempt to send price down and get their shorts closed in profit. And another thing, look left, where price is now. If you look to the left, you'll see that it's near enough preceded the whole of the green candle. Why? Because market makers built shorts at higher prices to close them lower at a later point.